Good morning. It's Wednesday, the 8th of October, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. And Mumbai is set to see the inauguration of two new infrastructure projects, the extension of the South Mumbai Metro Line and, of course, the Navi Mumbai International Airport, the second airport, which the city has been waiting for decades. And, of course, the Metro Line, which is a newer project, but nevertheless will quite smartly link North and South Mumbai in a manner not done all these years. The take. LG Electronics' 1.3 billion initial public offer was fully subscribed on the first day of bidding on Tuesday. Now, this IPO marks the culmination of one phase of a journey that began a few decades ago. The Koreans came to India, rather Hyundai did first, in 1996 at a time when the Indian car market was quite nascent. It launched its first model, the Santro, in 1998. LG India, the consumer durables giant, came exactly a year later in 1997. At that time, both Hyundai and LG as brands were barely seen or recognized on the global stage. If they were, it was often not for the right reasons, particularly Hyundai, whose image took considerable beating in the more advanced auto markets like the United States. But both Korean brands have done something which few international brands or companies have done in recent decades, which is to go public and list on Indian bourses. Hyundai listed a year ago in October, and LG will list later this month as its IPO raise now concludes. Most international companies and brands that have listed in India did so decades ago. Some of them were forced to do so by the Foreign Exchange Regulation Act of 1973, which mandated a maximum shareholding of 40%. Though some companies were ahead, like Hindustan Unilever, which went public in 1956, Bata in 1973 itself, and Nestlé in 1978. Other MNCs went public in the 1980s, 90s, and after the 2000s, it essentially slowed down to almost nothing. Maruti Suzuki, the Japanese auto company, was amongst the last major MNCs to list in 2003, though it set up shop in India in 1981 as a joint venture with the government of India. So the question to ask actually is, why are more overseas companies not listing in India, and what does it say about those who are, like LG and Hyundai? Now, sticking to automotive and noting the departure of companies like General Motors and Ford from India, at least the domestic market, it would appear that not only is India a tough market to do business, but going public calls for an additional level of commitment which may not be easy or feasible at an earlier stage. So, could one say it takes about 20 to 25 years before a global MNC reaches a level of comfort to take its roots deeper by going public? At least that seems to be the case with both LG and Hyundai. Many more companies have, of course, set up shop in India in the last 30 years and more. It is also not a necessary corporate strategy that companies with a large local presence will also list here as well. It is also not feasible that a company that's leaning on India as an offshoring base rather than as a market would list here. Conversely, it's only brands or companies that have really immersed themselves with Indian consumers, individual or institutional, over years that would consider and have done an IPO. Now, doing an IPO is, of course, a tough process. It calls for considerable preparatory work and, more importantly, a level of disclosures which you're otherwise not obligated to make. And these have to be made every quarter. And you're now answerable to shareholders in India and, of course, to global HQ. But the advantages to the economy are several. An MNC listing in India like LG and Hyundai is good for the Indian market and economy, apart from, as we said, reflecting a more permanent stake in the country's growth story. Willy-nilly, these Korean majors will grow the domestic business and thus the economy, and of course repatriate the profits and maybe some royalty too, which is also part of the game. Now, there is another reason such listings must be welcomed. MNC stocks and companies have generally scored higher on governance and returns to shareholders than the average. And they've also set benchmarks to follow. Their stock prices have reflected both business growth, brand strength, and of course high-quality management, talent, and pools. Hindustan Unilever or Nestlé are good examples when viewed over time, and thus a plus for shareholders looking for good companies with strong franchises to invest in for the longer term. India must thus encourage more MNCs to list in India and thus also, as we've said, develop deeper roots. There is a feeling that the current IPO rush, about $5 billion this month alone, is seeing some good quality IPOs, but also not so good ones. Now, that's also part of the course. But more blue chip MNC listings are desirable and must be welcomed. The Reserve Bank's move to ease up financing for investing in IPOs appears to acknowledge this or is responding to it implicitly. And then Japanese brands like Honda, Toyota, and Sony also arrived in the mid-90s amongst many others. As you look back, you can see what the opening up of a market, in this case India, after decades of isolation can do in terms of attracting capital, technology, and talent. And of course, create wealth for everyone, including shareholders in India. We're hopefully on the next stage of this immersion, absorption, and expansion. And that brings us to the top stories and themes now. Why are the stock markets rising right now? Gold hits fresh records even as gold futures are pointing higher. Decoding the outlook for the latest earnings season and expectations. Why is everyone suddenly talking about a glut in the oil market? And prices of potatoes, onions, and tomatoes fall sharply, bringing down the cost of a thali.
This is the Core Report with Govindraj Ethiraj.
Why are markets rising? Financial stocks are leading the rally right now, taking the markets up for the fourth consecutive session based on guidance that credit growth has started to pick up over the weekend. HDFC Bank reported a credit growth of 10%. Kotak Mahindra Bank reported a loan dispersal growth of 15.8%. All of this during the September quarter, according to Reuters. The Sensex was up 136 points to 81,926. The NSE Nifty 50 was up 30 points to 25,108. In the broader markets, the Nifty Mid Cap 100 was up 0.4% and the Nifty Small Cap 100 was up 0.3%. And of course, gold prices continue to rise, hitting a fresh record high on Tuesday, just $22 short of the $4,000 per ounce milestone, thanks of course to a persistent safe haven demand. US gold futures for December delivery have already crossed the $4,000 mark at about $4,000.90, and thus crossing the $4,000 per ounce mark for the first time, according to Reuters. Spot gold is, or rather was, about $3,978 after hitting an all-time high of $3,985 per ounce. Analysts told Reuters that strong ETF or exchange traded fund demand remains key, driven by a sense of FOMO or fear of missing out and eroding trust in traditional safe havens. They also said that ongoing central bank demand and lower funding costs were also keeping bullion prices high. Bloomberg reported Citadel's Ken Griffin saying investors are starting to view gold as a safer asset than a dollar, and that's a development that's really concerning. He told Bloomberg on Monday that we are seeing substantial asset inflation away from the dollar as people are looking for ways to effectively de-dollarize or de-risk their portfolios vis-a-vis US sovereign risk. So the dollar is, of course, one part of the problem and of concern to those who are watching that currency. But in general, when so many people start buying gold, I would also think it's a matter of some concern. The Indian rupee ended mostly unchanged on Tuesday, closing at 88 rupees 77 paise against the dollar, which was quite close to 88 rupees 78 in the previous session, according to Reuters figures. So, earnings season is upon us. How are things looking from a market's perspective in terms of expectations, given that the last 2 months have been somewhat disruptive to sales of several consumer-facing companies and actually disruptive in both ways, to be fair, both up and down, that is. Also, while we are seeing some good quality IPO listings, what will this rush that we are seeing right now of about $5 billion this month do to liquidity? I spoke with Sachin, Shah, whole-time director and executive director and fund manager at Emkay Investment Managers, and I began by asking him how he was looking at the next few weeks of earnings season.
We'll see the earnings season sometime early next week itself. We will see results start, and then of course we'll have a short break because of Diwali, and then we'll see again resumption of these results. If you personally ask me, I think July, August, September, it's going to be a mixed bag of results, particularly because if you see from 15th of August, since the announcement of the GST, there was a lot of pause in terms of the consumption demand, which will have its own impact across. Somebody might think, why would financial services have? But I think a lot of retail credit would have also got a bit paused out there. That's one part of it. Second, we've also had some challenges on the tariff side and a lot of uncertainty on the customer's mind and all of that. Of course, there would also be some bit of pre-buying which would have happened in the first half of this quarter. Overall, it's going to be a mixed bag. So more importantly, in this earnings season, more than the numbers, actually it's going to be the management commentary, because from 22nd of September till now, particularly for the domestic economy, domestic consumption, domestic demand, how is it playing out from 22nd September when the GST cut has happened? Plus, we've entered the festival season. Basically, we are already hearing a lot of good commentary as far as the auto demand is concerned, consumer durables is concerned, as far as the retail finance is concerned. So all of that, how is that fructifying? How is it that really playing out in the first 1 month or the first 30 to 45 days from 22nd of September? I think that's the commentary that we are more eager to hear, because that will really set the ball rolling for not only the third quarter, but I would think third quarter, fourth quarter, and at least the first half of FY27, effectively 4 quarters from here on, 4 to 6 quarters, if I can extend that also, because that is something what is going to probably lift the market in terms of giving us the earnings growth, which we have been not so good for the last 12 to 18 months. And also in this period, if we see some relief or some certainty or some clarity on the tariff side, that again we are hearing some murmurs now that things might get better from here on.
From what you've talked about, I mean, I can sense that the sectors that you've referred to, like automotive and retail finance, consumer durables, and consumer products. So, what are sectors that have not been affected, which you feel or could have escaped any earnings pressure in the last quarter or the last few quarters, if there are any?
Yeah, sure. So, say for example, if you look at the domestic pharma business, right, they are absolutely not impacted and they would continue to do very well. If you see the domestic pharma IPM growth has been good, high single digit to low double digit kind of a growth, which is a good growth for all the domestic formulation companies. We are also seeing some decent traction on the export side over there in terms of the pricing destruction or the pricing collapse that we had seen on the US generics market doesn't seem to be happening as badly off late. So that could be another good thing. So that's definitely one of the big sectors that I would say. Even I would say in IT services, which has nothing to do with this, the current GST or anything of that sort, but there the challenge is in terms of the global uncertainty, not only this tariffs or anything, but I think the overall uncertainty in the minds of the customers out there can create some bit of a challenges, right? So those are few sectors, but I think the most important is to see how the domestic demand revival is happening.
Right. So you're saying the last quarter or the quarter that went past is more like a staging ground to see how things could pan out in the coming quarters. And you seem fairly optimistic. Okay. The spate of IPOs that we've been seeing, and October is set to be a record month with over $5 billion worth of IPOs to be raised. And we've got two big ones going on, that's Tata Capital and LG. Are you feeling that this is sucking out liquidity from elsewhere, putting pressure, or is there enough demand for everyone?
If you take a really broader picture, I think there is enough liquidity, particularly for quality businesses. Of course, we are in a very, some bit of a bull market, which is where there is demand even for non-quality IPOs. It will always have an impact. For example, if you see the last 1 year, broadly, if you see Nifty, Sensex, or even most of the other indices, the returns have been broadly flat, right? If you see the last 1 year itself, the IPO, OFS, all of this primary issues or offer for sale from promoters has been in the range of good 4 lakh crores. So there has been some absorption of money out there. So clearly that has some impact in the near term. But what we have observed over a period of time, that if there are quality businesses, the market has enough depth and breadth to absorb all of it. So important thing is that we should have quality businesses coming up for IPOs. We should have businesses which can scale up very large. For example, if you see some of the new age businesses, when they came, they got a good run, then they all fell. But then a few of them, which have actually scaled up very well, which are on the path to profitability, are seeing significant amount of wealth creation for the investors out there. So I think as and when the IPOs, which are quality businesses, and when we see them scaling up, there's enough breadth and depth for more and more liquidity to come into the market.
This has happened in the past as well, that if it's a good quality IPO, so let's say an IPO from a Tata group would be considered good quality, is not going to crowd out or not going to get crowded out by poor quality. Regardless of whether there are many poor quality IPOs, good ones will continue to attract capital.
Yeah, absolutely. So what we believe is that the quality of companies which come for the offering have to be good. Second, the growth has to be good. And third, also important, they have to come at a reasonable valuation. Because some of the times we have seen that some of the businesses get too highly priced and not leaving too much for the investors on the table, then those stocks don't really give you great returns. And we have seen this multiple times in the recent past, in the distant past, all of that. So I think even in the current environment, there will always be certain IPOs which are more than perfectly priced. So from that perspective, that's a little bit of a challenge. Important thing is that we get quality businesses at reasonable valuations.
And yeah, I guess price is an important thing, which Tata Capital seems to suggest that they've spent a lot of time thinking about it. Okay, last question. So, given that we are coming close to the end of the current Samvat, I mean, not the calendar year, and as you mentioned it, we've been a largely flat year so far. What's your sense for the rest of the calendar, if not ahead?
Yeah, so we are fairly optimistic. And I'll tell you where we are coming from, right? Because if you see from the last 6 to 7 months now, or in fact now almost 8 months, from February when the budget was announced till as recent as this September, we've had so many positive interventions by the government, by the regulator, and also, if I can add, from the nature side. So it started with the tax concessions in the budgets. Then we had good liquidity ease. Then we had interest rate cut. We've had a very good monsoon, and now we've had a GST bumper bonanza, right? So all of this should actually start playing out beautifully for the domestic demand to come out. So our sense is that the earnings growth should be very strong in the next 12 to 18 months. And because of that, that will drive the stock market prices and returns. I would be very comfortable in saying that the next 1 quarter to maybe 4 quarters, we should see a good double-digit returns as far as the Nifty or the Sensex is concerned.
Right, Sachin, pleasure talking to you. Thank you so much for joining me.
Thank you.
Why a glut? OPEC plus oil producing countries opted for only a modest rise to November output thanks to concerns about a potential global glut, sources within that group told Reuters, as non-OPEC supply also rises while fuel demand growth slows. So oil prices are hovering around $65 a barrel right now. They're down, lower than, of course, the $82 peak that we've seen this year. Reuters also quoted analysts saying the market could see a growing surplus in coming months as the summer driving season and Northern Hemisphere autumn harvest ends and supply grows from OPEC plus, as well as non-OPEC producers like the United States, Brazil, and Guyana. The Paris-based International Energy Agency has also forecast a 2026 surplus. OPEC's latest available forecast, however, suggests a deficit for 2026 if the group maintains output flat at August levels, according to Reuters again. So, why is there almost suddenly talk of a glut, and what could that mean in terms of demand and supply? I spoke with Vandana, founder of Singapore-based Vanda Insights, and I began by asking her what was driving this talk.
Hi, Govind. So great to be back with you. You've picked up a really key topic. Pretty much, I think that's on the lips of everybody in the market, stakeholders and participants right now. Where is the glut? It's become a topic of considerable debate. You're asking why. Let's call it why is there an anticipation of a glut? So a few reasons, I would say chief among them being that a few very credible, closely watched agencies have predicted a glut. They have especially a growing glut, the likes of the International Energy Agency, to some extent the US Energy Information Administration. In general, think that this year was an oversupplied year. And then after OPEC Plus began unwinding its cuts and then accelerated them, to some extent, these agencies and several other analysts, including Wall Street banks, have doubled down on those predictions. Now, what has made the situation a bit peculiar is that usually you don't have to wait on the edge of your seat so long. If there is a glut, there are countless ways. I mean, these are very efficient markets we're talking about, right? There are many signals that start appearing, all of them pointing to the same thing, that there is more supply than demand. Some of those signals are obviously in the prices and the forward structure. When we look at the futures curves in crude and sometimes in refined products, you look at the differentials, the premium or discounts in the physical market that buyers are having to pay. And then you look at what stock levels are doing on land and on the sea. Now, what has made this curious, the phenomenon of waiting for the glut, is that these signals are really either transmitting very weakly or simply not all of them combining to very categorically say, let alone a glut. Glut is an extreme oversupply, but that there is even a considerable oversupply in the market.
Right. So if you're saying that essentially the signals are mixed and not clear, what is then the missing factor here, which is causing people to maybe reach this conclusion or jump to this conclusion?
It's hard to say definitively, Govind. I can only speculate. It could be that the predictions based on a certain number of barrels of global demand and certain number of barrels of global supply. These are always difficult things to do anyway, right? There's a possibility that these projections are a bit off. So, some agencies are calling for as much as 3 to 4 million barrels per day, some even more of excess supply. That may not be the case. Now, there may be some excess supply, and I would completely anticipate that to be the case with the group of eight unwinding first the 2.2 million barrel per day of cuts, which they did in an accelerated manner, all crunched into 6 months instead of 18 months. And now they've started on a second tranche of phase out of cuts, all of it boosting supply. So yes, I would anticipate that perhaps the fourth quarter of this year, going into the first quarter of next year, we're going to have an excess of supply. But perhaps it's the 3, 4, more than 4 million barrels per day ends up being a bit of a miscalculation. That would be one explanation.
Right. You also referred to seaborne crude, and I mean, there have been reports that seaborne crude is also high or almost record high, perhaps. So, why is that the case? And what does that signify?
So, without getting too technical about it, I think it is important for our listeners to be able to differentiate between the various terms that the market uses, right? There is floating storage. Within that, you have a long term floating storage and a short term floating storage. The short term floating storage is usually the one that moves up and down quite a bit and is a good indicator of, whether there is excess supply or more demand than supply in the market. So what we're seeing in that story is that, yes, oil storage levels have grown. So basically, this is oil put on ships, which is like sitting around for a while instead of simply going from point of supply to point of production to point of consumption. The other is essentially oil on ships, which are basically on their way from the supplier to the consumer. Now, those volumes have grown, and some analysts I see are clubbing it all together. I have my reasons to why they might be doing it. Sometimes, you sort of wed yourself to a theory, a thesis, and then you go looking for data that will prove it. So it might be that. But look, to my mind, how much oil there is on water as a result of ships simply having picked it up from the origin port and on their way to the destination port really tells you that there is more supply, yes, but also tells you there are also buyers. There's a market for that oil. So I wouldn't club all of it together. So be careful when you see figures like about 1.2 billion barrels of oil on water. That includes simply oil that has been sold and bought and is simply on its way from the supplier to the consumer. As far as the short-term floating storage oil is concerned, yes, it's gone up, but look, Govind, it's a 2-year highs. That's nothing to write home about. So again, as I said, is there oversupply? Probably there is, but I wouldn't call a 2-year high of short-term floating storage a glut situation.
Right. And last question. So, how's your outlook right now, given that we slipped below $65 a barrel last week? And we've also, of course, seen peaks of $82 and mostly oil above $60. So, is there any sense on how it's looking for the next few months?
Yeah, I think OPEC's decision to go with a 137,000 barrel per day hike, which is, I call that nominal or token hike in target for November, calmed down quite a lot of the bears who were heading for the exit doors last week. So we see that crude has stopped its sort of relentless tumble that we saw last week. But at the same time, compared with like Brent almost 9% down through last week's sell-off, it has clambered back up just a fraction of it. So maybe about $1.60 out of the $6 decline we saw last week. So what that is telling us is that there may be a temporary floor to the market. The worst fears of the bears or of the market, let's say, that OPEC Plus is going to come out with another flood has not happened. But at the same time, look, I see the upside quite limited. For a long time now, the upside has been mainly driven by supply risk premium attached to specifically Russia. The US, the West, the G7 and the European Union are still wrangling over their plans for another sanctions package for Russia. I do expect something will come out. There will be more sanctions, but I think they will steer clear of very, very stringent measures. So I don't expect that to inject any substantial risk premium, let alone curbing Russian oil flow. So all said and done, where that leaves us is probably mid to high 60s for Brent is where I see for the remainder of this quarter.
Vandana, it's been a pleasure as always. Thank you so much for joining me.
Thank you for having me, Govind.
Thali prices are down. In September, the costs of a home-cooked vegetarian and non-vegetarian thali or a full-plate Indian meal declined about 10% and 6% year-on-year, respectively, thanks to benign commodity prices, according to CRISIL. The decline in the cost of that vegetarian thali, importantly, was led by a sharp drop in prices of vegetable and pulses, and potato prices were down 31% because of dumping of stocks by cold storage units. Tomato prices fell 8% on the back of higher supplies, and onion prices have fallen 46% because of higher rabi supplies entering the market and an increase in domestic supplies resulting from the bearish import momentum from Bangladesh, which accounts for about 40% in India's onion export basket, says CRISIL. Elsewhere, prices of pulses declined 16%, vegetable oil prices were up 21% due to higher demand at the start of the festive season, and there's been a 6% increase in prices of LPG or cooking gas cylinders. The increase in prices obviously ensured that the thalis could not be cheaper. Broiler prices, which drive the overall cost of a non-vegetarian thali, were mostly steady, only falling about 1%. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.